Is higher inflation to end to low interest rates? Well, the latest inflation figures showed an uplift at 2.1%, which is within the Reserve Bank's window for inflation. So there's been lots of speculation in the media about what's going to happen to interest rates, what's going to happen to housing prices, and what this will mean to the value of your and my home. That's what I wanted to discuss today with Dr. Andrew Wilson in this week's Property Insider video. But if you want to keep up to date with all that's happening in property, please subscribe to our YouTube channel and click the little bell icon so we can let you know each time a new show comes out. With the latest inflation figure showing an uplift to 2.1%, which is within the Reserve Bank's 2 to 3% window for inflation, over the last few days the media has been rife with speculation that the Reserve Bank will hike up interest rates sooner rather than later. In fact, the money markets have sent the 3-year bond rate into the stratosphere, and they're now pricing the chances of an interest rate rise in February next year at 75%, and traders are gambling that there could even be 4 more interest rate rises to follow in 2022. If the money markets are correct, that would send borrowing rates higher at a time when small businesses around Australia are trying to recover from the pandemic lockdowns, and it's also going to affect housing affordability at a time when already affordability issues are restricted. So what does this mean for interest rates? These are some of the questions I'm going to be asking Dr. Andrew Wilson, Australia's leading housing market economist and chief economist for My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Yeah, hello, Michael. And we are in the midst of cup fever, are we not? I think all that speculation in terms of imminent, it seems, interest rate increases is almost tempting to take a bet on that, because I think really we need to take a cold shower, particularly in terms of those inflation numbers in relation to their impact on an imminent, it seems, interest rate increase.
Well, I'm interested in your thoughts on that, because inflation's rising around the world, United States, United Kingdom, New Zealand, and now we're getting a little bit of inflation. And that's, of course, been caused by supply chain disruptions, soaring energy prices, labour shortages. These all seem to be short-term factors, Andrew, related to COVID-related restrictions. But what's the Reserve Bank now going to do when it thought that we wouldn't reach inflation of around 2% till mid-2023, and it's come a little bit earlier?
Well, it's come earlier because of one-off factors, Michael, and I don't think we should be looking at what's happening in overseas economies to determine what's going to happen here, particularly given we know that the 2 main factors that increased that underlying inflation up to 2.1% were home building costs and, of course, fuel. And both of them relate to the adjustment process we are going through now in our post-COVID recovery. I guess the surprise was underlying inflation moved up to 2.1% annualised, which was quite a significant jump, and back into that 2 to 3% band. Headline inflation actually fell, and of course that's not a good story for the clickbaiters in the media and those that fertilise their commentary with ifs and buts and maybes. But the headline always drags you in, of course, and that's the plan. But when we look closer at that inflation data, we can see that there are 2 main components, and that was given a little bit of lip service, acknowledged, but still given lip service. And those main components that did drive underlying inflation higher were near record fuel costs. And we all know that, how when we go and fill up the car, Michael, and how high petrol prices are at the moment. And that's a very significant part of the inflation factor. And the other one was building costs, which is also a significant contributor to the inflation model. But we've seen skyrocketing building costs and house costs. The ABS measures in the inflation model house costs as being the cost of detached housing to build. So it's got nothing to do with prices of houses. It's got nothing to do with apartments. It's about the cost of detached houses to build. And that's how they measure that house cost component of inflation. So if we deal with that rationally, if that's possible, Michael, when speaking about inflation, first, we know that we're going to see higher building costs because we've dragged forward so much demand through the home builder policy that has expired now, and that's important to note. But home builder dragged thousands of new home buyers building houses, particularly houses, of course, into the market. We saw a record surge in new house building. Of course, supply is always a laggard in terms of matching sharp increases in demand in the building industry, because you just can't produce thousands of new tradesmen overnight, and we don't have excess inventory stocks of building materials. So, of course, building costs have gone through the roof. It will take some time for that to adjust, but we have stopped that home builder program. We've seen a sharp decline in building approvals, and loans for new houses have also declined sharply, stabilised a little bit over the last month or two, but half of where they were at the peak of that home builder surge earlier in the year, Michael. So that's not going to last. Building costs will adjust. In fact, higher building costs for those that missed out on the home builder plan will actually push more buyers out of the market in the shorter term, because prices will be too high for them to be into the marketplace. So short-term driver, a significant force, because housing costs are a significant component of inflation. Now, the other significant component, of course, is fuel. And that was the other key driver of higher underlying inflation. Now, we have had a surge in the price of oil. There are a number of reasons for that. We've seen perhaps a surprising increase in global economic demand on the upside that was not expected post-COVID, if we could call it post-COVID, and that has increased demand for fuel. So that's one factor, and that supply again has taken some time to catch up with that surprising increase in demand in advanced economies particularly. There are some other factors, Michael, which I'm not going to go into in too much depth, but one of them is that we've seen strong increases in the price of coal and also in the price of natural gas. A lot of the demand for fuel has been shifted across to oil as a replacement for heating from natural gas and coal. And that's been another increase in demand because of substitute goods. And the other thing is there have been some significant supply constraints, particularly coming out of the US, where a lot of their, if we remember, they've had some issues with weather, hurricanes, etc., which have impeded the capacity of them to supply oil. And so there's a number of factors there that are working. These things, we don't have an underlying shortage of oil globally, although, of course, that was the favoured go-to prediction in the 90s that we were going to run out of oil anytime soon. Well, that hasn't happened, has it? But, the same old, same old. So we have plenty of issues. We don't have any issues with medium to longer term supply. It's just these short-term constraints, which are basically a response again to COVID, increased demand that wasn't predicted, and of course, those supply constraints. So this isn't something that's going to impact us in the medium to long term, in my opinion. So any speculation, particularly that, how many interest rate rises are they predicting, some of them? It's just crazy stuff. Don't get a financial journalist or a market economist. Don't let them get in the way of a runaway story on inflation. You can see them, their mouth watering at the prospect of those clickbait headlines. And it was always going to happen once we got underlying inflation higher than expected. But just to finish, on the inflation, higher interest rate story, the real focus on the prospect for interest rates will come with a thud in a fortnight's time when we get the wage index numbers for September. Now, the Reserve Bank has been adamant that, and so they should, and all power to them, that they're looking at wages growth, which is very low and has been low for a decade, as being a part of that story for higher interest rates. In other words, unless we get higher incomes, it doesn't matter what's going to happen with inflation, we will not be getting higher interest rates. And we've said that to death here, Michael, over and over again. But, you get the glazed look from the clickbaiters because it doesn't add to their storyline. But we will get that wage index data from the ABS in a fortnight's time for the September quarter. And I think that we're going to look at one of the lowest real incomes growth outcomes that we've had. And because I think we'll look at around about a 1.7% annualized increase in wages. If we look at the previous month, there's nothing really suggesting that we're going to see a surge in incomes. And if we match that against that 2.1% underlying inflation rate, it will mean on that speculation of a 1.7% increase that we would have seen real wages falling by 0.4%. And we haven't seen real wages fall for nearly a decade, Michael. And that would be one of the sharpest declines in real wages over annual real wages growth measured over a quarter that we've had. So that would be the absolute last thing that the Reserve Bank would be considering, or probably the first thing they'd be considering when thinking about higher interest rates, because you don't want to have, when actually real wages are falling, a clunky Reserve Bank or central bank moving in and pushing up interest rates. Hello, market economists. Are you there?
Well, only last week, Reserve Bank Australian Deputy Governor Guy Debelle confirmed what you've been saying week after week here, Andrew, that ultra-low interest rates have contributed to housing price rises. We know that, but it's also maintained jobs, and they'd be endangered if rate rises are going to occur. And the Deputy Governor maintained the position that the accommodative interest rates have supported a return to jobs after these successive lockdowns. He again confirmed what you've said, that no, interest rates aren't going to change until wages go up. And yeah, it'll be interesting to see those figures.
But I even saw a headline somewhere of speculating on hyperinflation, the stuff of the Weimar Republic of the 1920s. One clickbaiter was speculating on, will we get hyperinflation? Of course, reading the article through, you would have seen lots of qualifications that, this won't happen likely, but it's still that headline that's better than the inflation headline. Let's go with hyperinflation. Crazy stuff.
Now, there was talk earlier this year also about a double-dip recession, but recently the federal government advised that it got a $7.8 billion improvement in the budget bottom line. Despite the lockdowns in New South Wales and Victoria, government payments rose considerably over the last quarter. So the fears that we'd end up plunging back into a recession, they've gone away, Andrew.
Yeah, well, it was meaningless last year anyway, wasn't it, Michael? Lots of shock horror when we had that 7% decline over the June quarter in GDP. But of course, that was always going to happen when the economy was shut down. We bounced back very quickly. Really, in a sense, wasn't a recession because GDP fell by just 0.3% over the March quarter. So it was basically steady. It was really just that June quarter collapse that created the recession. And it didn't mean a thing because we were off and running. And if we remember our past recession, which was, let's call it a real recession, that lasted for a decade until we got back into more of a normalised environment. Recessions are typically a reflection of an economy with underlying stress, and these things don't return to normal quickly. And we did return to normal quickly, very, very quickly, and only interrupted again by more lockdowns. And obviously, we're not going to have anywhere near the impact from the recent lockdowns on our economy that we had last year, Michael. And it may even be a close thing in terms of the September quarter GDP numbers. We might end up in the black. I'm not sure about that, but certainly the December quarter has a prospects of being a positive growth. And once again, it's fun to read crazy headlines. Just don't act on them. You've just got to ignore them.
Looking at our property markets, there are more properties coming up for sale at the moment, even though they're being snapped up as quickly as they're coming onto the markets. And the auction markets managed those higher volumes very well last weekend.
We've seen the Sydney market just falling away over recent weekends, Michael. A lot of that has been, I believe, because of higher listing numbers. But the Sydney market bounced back against that trend on the weekend. It was above 80% again, clearance rate. We always use 80% weekend clearance rates as a benchmark for boom time conditions. But there was a very big number of auctions in Sydney. So it was the Sydney market absorbed a sharp increase in listings, high listing numbers, the highest since lockdown, and an 80% clearance rate. So it'll be interesting to see how that pans out over coming weekends. But we always see a surge in listings from this time of the year, Michael, through to the end of the year. People want to close out their transactions for Christmas, and we do see a surge in listings, and that always puts downward pressure on clearance rates, that extra supply. And of course, a lot of purchasers have conducted their sales by now, middle of spring. So you have fewer buyers, but we may not see that same energy because we've had lockdown and buyers have not had the opportunity to engage in the market in Melbourne and Sydney because of lockdown early in spring, and they're now coming back in. But Melbourne similarly had another good result, Michael, and I think Melbourne's the market with plenty of upside because of the interruptions it has to suffer, not just this year, but over the past 18 months. And Melbourne's just been really crying out for some clear air. Hopefully it's got it now, the Melbourne housing market. And we saw another 80% clearance rate in Melbourne, despite a big number of auctions, nearly 1,200 auctions in Melbourne at the weekend. And that's over a long weekend. It was traditionally our Melbourne Cup long weekend where there's a lot fewer auctions. So going forward, we will see more properties going under the hammer. Question is, what is the buyer depth in Melbourne and Sydney? There's certainly a little different this year because buyers have been constrained, and I would expect clearance rates to remain around about where they are at the moment. But as we know, the auction market is a very good real-time indicator of what's happening generally, particularly in Melbourne and Sydney, but also in the other markets. I noticed that Adelaide had a very big number of auctions in Adelaide. That Adelaide market's really coming out of left field, not just for its high clearance rates, but also high numbers of sales with those high clearance rates. And of course, Brisbane and Adelaide just keep on keeping on. There's really no sign here of an easing in the current seller market environment, Michael.
And that's shown in the latest figures too for the month of October, where they've actually, property values around Australia have increased much the same as they have for September and August as well, even though the various states are doing things slightly differently. Brisbane's been a really strong market over the last couple of months, Andrew.
Yeah, leading market now, the Brisbane market, in terms of prices growth. We know there's a lot of factors driving that Brisbane market, particularly migration. That's a sign of an exodus, particularly out of Victoria and Melbourne into southeast Queensland. I just want to mention, we were speaking about inflation before, Michael, and talking about the Brisbane market. And we did speak about building costs and that they're responding to that home builder policy. I'll tell you something that's also interesting that I guess the pundits didn't look at or don't look at. Other than the fact that this is a short to medium term blip in inflation, in my opinion, is when we look at the capital cities where the most energy, or I guess the highest building cost increases have been, it's well and truly Brisbane.
Really?
Oh yeah, Brisbane is head and shoulders above any of the other capital cities in terms of increases in home building costs. In fact, it's quite spectacular when we do compare building cost changes, of course, which was a significant part of the underlying inflation rising. When we look at, there's a very strong disparity between the capital cities. Most of them are reasonably moderate, but the Brisbane building costs went through the roof over the September quarter, which is quite. And of course, Brisbane's been has had a lot of activity from that home builder policy. And by contrast, building costs in Perth actually fell over the September quarter. So again, we need to look at a little bit more depth to understand why this is not going to be, in my opinion, something to get terribly excited about in terms of the prospect of interest rate rises anytime soon. And just another reinforcement for the strength of that Brisbane market, Michael.
Sure. One of the other factors taken into account in inflation, and it's not as big as building costs or house prices, is rentals. And rentals rose in Brisbane as well. They fell in Melbourne and Sydney, but it was made up for by rises in the other states.
Yeah, absolutely, Michael, and that you're spot on. And that was another factor. The Reserve Bank has been talking down a shortage of rental properties for a couple of years. They're now having to change their tune considerably. We know that the only real excess of rental stock is in the markets of Melbourne and Sydney. They acknowledge that. But we know there's a number of factors that are driving that. We are seeing that unit stock, apartment stock in Melbourne and Sydney being soaked up now, and rental declines in those markets are starting to ease. And once we get open borders, and I noticed that the first plane load of students is due anytime soon now, Michael. So when that happens, we'll really see those apartment markets start to find tenants again. But everywhere else, there's a shortage of rental property. House rents are going through the roof. A number of factors there. And as you mentioned, Brisbane's again at the lead in terms of increasing rents. And it's just that wave of migration that's coming out of southern states that's driving higher prices and higher costs.
Well, there's lots of news at the moment, and there's more coming out this week, so I look forward to catching up with you next week. We couldn't help but talk about interest rates again, despite discussing the last couple of weeks, because they're just not leaving the media, are they?
No, but we love that, Michael. It's the voice of reason is always needed, particularly when you're talking about decisions that affect your financial future. So here we are.
Okay, look forward to chatting again next week.
Thank you.